Give us a sense of where the opportunities, and let me ask you specifically, do you think there are opportunities in China, given we're about to go into the NPC, we're about to see President Xi re-upped?
I do. I think there are opportunities and options in China specifically because there's an event. And that's what options love the most. They love to play an event because anything that could potentially increase your volatility can increase the value of your options. So for folks who have been looking at the China reopening story, that may be a way to get back into ASHR, FXI, EEM calls, which we've seen before in the beginning of the year and may be reloaded now.
So David, where do you see opportunity? You like bonds.
Well, yeah, we think if the Fed takes aggressive action that you can invest in long-term bonds. We also still think there's opportunity in China amongst those companies that benefited from the economic miracle that happened in China, the tech stocks there. But we'll be keeping an eye on seeing if Chinese capitalism is something that we recognize as Western investors. But there are parts in the U.S. equity market where we see some opportunities. Look, these interest rates keep going up. The jobs market keeps holding up. That's a good combination for banks and bank profitability. But the rest of the equity market you need to be careful on.
But what about that, Amy? You talk to your clients a fair amount. What are they interested in right now?
You know, the one thing that I think is really important to remember is if you look back 5 years, 10 years, the cost of tails, so essentially a 3 standard deviation drawdown on the market, is actually trading kind of in its lowest percentile, which I think is very interesting because there's a lot of uncertainty around terminal rates. We're kind of in a completely new rate regime, and that volatility, while it's picking up, hasn't really reflected that to the extreme that I think we may go to.
Are people getting paid for taking a risk?
So, you know, volatility is quite high. So, of course, if you're selling volatility, you're collecting that premium. But I think it's dangerous because essentially what's happening right now is you're actually realizing more than the options are pricing in for the future.
What about other sectors, David? I mean, you mentioned banks. What about big tech, for example? It had a hard year last year. Where is it this year?
It's off to a terrific start. The proper tech titans, the ones that are in the technology sector, have held up really well. And I think part of that is that people are seeking the stability of those businesses, the strength and resilience of those businesses. And don't forget, those are strong balance sheets with a lot of cash, earning more interest income than they did in years past. But we also try to look at the market as to where is there upside that's worth the risk. I see that in healthcare. There's more risk, but good upside in banks. And tech, we're underweight now. We've moved more significantly underweight on it. We're sticking more with things like communications, where we see more of a price discount and more upside worth the risk there.
Amy, what do you think about healthcare? David mentioned it.
Yeah, it's interesting. We just went through an exercise essentially through our universe of covered companies within the RBC universe. And we essentially looked at their Sharpe ratios. We just said, given that the risk-free rate has gone so much higher, you know, where's your excess return attractive per level of volatility? And healthcare is actually one of the sectors that is ranking quite well.
That's interesting. Healthcare, you think, is a strong one.
Yes, it had a tough start, as I think there are investors running to the cyclicals or running to the defensives, or maybe leaving the equity asset class to go into bonds, which is an alternative, powerful alternative at this stage. Healthcare got left behind, but I think that's the sector for the decade.
When we're talking about equities, obviously we're talking in part about earnings expectations. Where are we on earnings? Have we bottomed out?
No. They keep drifting down, almost in a painful, steady, gradual drip of downward earnings estimates for especially the first half of this year. I think at the best, S&P earnings will be flat at about $222, which is what earnings were last year.
So, Amy, as I understand Sharpe ratio, which is limited, it's a combination of volatility and return, what you're going to be likely to get. When you look at that, where do you see the highest volatility, the highest return?
Yeah, so essentially what the Sharpe ratio is saying to you is, you know, for the level of heartache, the level of risk that I'm taking, where are you getting your most return? So as I mentioned, healthcare was one of the sections we looked at, which looked attractive. And interestingly, the other is large cap technology. And the reason is actually not related to the excess return. It's actually because the volatility's come in on a 12-month basis in those stocks.